So today we're going to talk about the difference between a Roth IRA and a Roth 401k.
So,
Yeah.
what is a Roth?
So Roth's basically a tax-free account, right? So the money goes in after taxes. It grows tax-free. And then during retirement, you get to take tax-free withdrawals from that account. The Roth 401k is very similar, right? Basically, it's just the 401k option. So it's a Roth account, but it's for your 401k. Right?
So your contribution levels are different.
Contribution levels are different. Same benefits. The money goes in after tax.
Yeah.
It goes tax-free. And then you can take out those withdrawals tax-free in retirement.
Now, how does that compare to like a regular 401k? So a regular 401k or regular IRA, right? The money goes in pre-tax essentially, or you get a tax deduction for it. So it makes it
Yes.
pre-tax. And then it grows tax deferred.
Yeah.
But it comes out taxed.
So once you take those withdrawals during your retirement, your withdrawals are taxed during your retirement from that account.
Who would benefit the most from a Roth compared to like a traditional IRA or 401k?
So it depends. There's a couple different scenarios in which it would make a lot of sense. One is if you're young, because basically when you're young, you may be in a lower tax bracket, and you also have years to let that money compound and grow. Therefore, basically in your retirement, you get to take all those compounded returns, all those earnings that you made in that account, you come out tax free, which is great. The other scenario where a Roth may make more sense for you would be if you think that you're going to be in a higher tax bracket in retirement. So for a lot of our clients that we've worked with, what we found is that if they have a lot of taxable or tax deferred assets, like a traditional 401k or IRA, basically they get hit with this big bill from their RMDs. So we haven't talked about RMDs yet. RMDs are required minimum distributions.
Mm-hmm.
You're required to take these from tax deferred retirement accounts.
Once at a certain age, right?
Yes. Once you reach a certain age, you have to take these RMDs from the accounts. What we found is that they occasionally, depending on the size of the RMD, push people up into higher tax brackets in their retirement. So the other scenario in where Roths may make more sense than tax deferred accounts like traditional IRAs or 401ks would be if those RMDs are going to push you up into a higher tax bracket, you might benefit from being in a Roth because Roths aren't subject to those same RMD rules.
Just to give an example, so an RMD, once you hit like 73, let's say, is about 3.5% to 4.5% of your account. There's an IRS actuarial calculation. So if you have a $1 million 401k or IRA, or you have a $2 million, that might be $40,000 or $80,000 that you're required to take out of the 401k or IRA, even if you don't need the money.
Exactly.
The IRS basically says all these years we gave you tax deferral, and now we want our taxes.
Now let's kind of get into when would you use a Roth IRA? When would you use a Roth 401k? And is one of them better?
That's a good one.
So the Roth IRAs are great. The maximum contribution you can make per year is $7,000. If you're older than 50, you get that extra $1,000 catch-up contribution. So still a powerful account, but the Roth 401ks do have a higher contribution limit, right?
It's like the Roth IRA on steroids, right? So instead of $7,000, you can contribute up to what?
$23,500.
And then if you're over age 50,
then you get an extra $7,500 contribution
instead of the $1,000 in the Roth.
Yes.
So if you're over 50, instead of $8,000, you can contribute $31,000.
So that's a massive difference. Why that's important is because obviously you might be thinking, well, I can't even contribute $23,000 a year into any account. So why would it make sense for me to do a 401k over an IRA? And the reason is, especially if you're a high income earner listening to this, there are income limits on a Roth IRA
that you don't find on the 401k.
Exactly.
Right?
So that's what makes Roth 401ks very powerful investment vehicles for high income earners.
Yeah. So like if you're married filing jointly, it's in the mid 200,000 range. You now can't contribute to a Roth, right? Like there's a phase out range.
Yeah.
But if for a 401k, you could make $300,000, $400,000, $500,000 and still be able to contribute to the Roth portion.
Exactly. So you could max out significantly more. In one hand, you might not be able to even contribute to a Roth IRA. On the other hand, now you can contribute $31,000 potentially or more to a Roth 401k.
Right.
So that's just giving you more tax-free assets. And like we were just saying with the RMDs, typically high income earners might have portfolios that are very heavily centered around tax deferred assets.
Yeah.
Right. So they might come into some situation where they have huge RMDs in their retirement, pushing them up into higher tax brackets.
Yeah.
So the ability to be able to save as a high income earner into a tax free like investment vehicle could be massive for your retirement.
Right. Now, one thing is the Roth 401k or a 401k in general, you can only contribute up until December 31st of the tax year. Whereas with the Roth IRA, you have until filing the next tax season, so April 15th, essentially, to put in the contribution for the Roth. So that would be one thing. The other thing is the 401k, you should almost always contribute because of the match.
Yeah, I was going to say the match is there. It's almost like they're giving away free money depending on how much you contribute. So, even if they only put the match towards your traditional 401k, it's still a huge benefit that you don't get contributing to a normal IRA or individual retirement account. Right.
So let's talk real quick because we're at the end of 2025, right? So for 2026, how do the contribution limits change? So for a regular IRA, Roth IRA, what would be the maximum you can contribute?
So
in 2026?
For 2026, the maximum is $7,500.
And the catch up?
The catch up's an extra $1,100.
So instead of 1,000, they actually increased it by 1,100.
Yeah. So it's 1,100. So it brings your total contribution to 8,600 for 2026. If you're over age 50, right? For the Roth 401k, it rises to 24,500 with the catch up. If you're age 50 or older, at 8,000. So the total contribution for 2026, if you're 50 or older, would be 32,500.
And if you're between 60 and 63,
oh yes, so they added
a
a super contribution. So for 2025, it was an extra $11,250 as the super catch up. Which is an interesting provision because it's only from 60 to 63.
Yeah.
So it's like basically if you work till 65, those last 2 years, you're back down to the normal catch-up contribution. But yes, that's another benefit that you get to 401k accounts.
So for 2025, that catch-up provision is
$11,250
and doesn't change for 2026.
Same in 2026.
Okay.
So another added benefit to being in a 401k rather than an IRA. So there are benefits to both.
Yep.
And there are times where you may want an IRA compared to a 401k, for example, investment options.
That's a good one. So let's talk about that for a minute. Investment options in a 401k, your investment options, whether it's a traditional 401k or a Roth 401k, are basically dictated by the plan.
Exactly. Yeah.
Right. So most plans have, say, 30 options or so. You have the target date funds and you have different types of funds. Some allow like a brokerage component, but for the most part, you have some mutual funds and maybe in future some ETFs.
Yeah.
Now compare that to a Roth IRA to brokerage fund.
So then a Roth IRA is pretty much any stock market investment that you can think of. So between ETFs, individual stocks, mutual funds, you have bonds. Yeah. So you have pretty much any investment vehicle that you'd want, I guess, any traditional investment vehicle.
Let's talk for a minute about one of my favorite subjects now, which is a self-directed Roth IRA.
Yeah.
Right. So now traditional brokerage, stocks, bonds, mutual funds, ETFs, individual bonds, individual fixed income, things like that. But in a self-directed IRA, what can you do?
Well, you could purchase things like crypto, for example. So if you are, since crypto is not a regulated investment, it's more like a commodity right now. It's being treated as. You could essentially invest in crypto in your individual retirement account if it's a self-directed account.
Now think about the tax situation, right? So right now with crypto, it's a bear. The firms have to start coming up with 1099s like Coinbase, Gemini and all, but tracking your cost basis, you're supposed to be able to have to do that in your wallets, right? Everything. But now if it's in a Roth, self-directed Roth, no tax consequences, right? So everything grows tax-free in there. But then you can also do real estate investments. You can buy a property in there. You can do a REIT in there. You can do a private placement. You could do private equity.
I would say arguably for now, Roth IRAs are still the more flexible investment accounts.
Yeah, I agree.
Compared to a Roth 401k.
Yeah.
But specifically, I mean, just to go back to why I think Roth 401ks are powerful would be for the high income earners.
I mean, high income earner and in retirement, they expect to be in the same or a higher bracket.
Exactly.
Yeah.
So just because they're able to have access to that tax-free account that they wouldn't have had access to previously because their household or individual income's too high.
Now, how about if they're high income earners today, but in the future, they expect to be in a lower tax bracket?
I mean, that you can make the argument then to say that tax deferred assets like a traditional 401k or a traditional IRA make more sense because you don't want to pay, you would want to pay taxes later when you're in a smaller tax bracket rather than pay taxes essentially on those contributions you're making now when you're in a higher tax bracket.
Unless you either think that tax brackets are going to be raised in the future.
Yeah.
Or when you factor in RMDs,
Yes,
right? It's going to affect either your Medicare taxation or it's going to affect the fact that you have to take out larger RMDs that you're going to need.
Yeah.
And that's going to push you in a higher tax bracket.
Yeah.
Or the other one that I love to talk about is for inheritance. If you have the choice of passing your wealth to your children, either tax-free or the government takes, say, a third of it. Right.
I think that's kind of the big note. And obviously, having a financial plan answers a lot of these questions for you. But typically from what we've seen is that having some tax deferred, some tax free, and some taxable makes sense. Just to kind of hedge yourself against any potential outcome in the future.
Yeah, and that just started me thinking of how the government's forcing that issue anyway. So if you're over age 50 and you want to make those catch-up contributions starting in 2026, if you made more than 145,000 in 2025, 145,000 in 2025, now the catch-up contributions for 2026 have to be in a Roth 401k.
Yeah,
so you can make your contributions up until the catch-up in a traditional 401k.
Yeah.
But then anything above that has to be in the Roth 401k.
Yeah. So I think one of the most important things would be, first of all, check if you have a Roth 401k available. Right. I think some people kind of just hear 401k, they sign up for the 401k, and then maybe they signed up years ago and the employer just recently kind of implemented a Roth 401k.
Yep.
So check to see if it's available. There's also, if you're a solopreneur, solo 401ks.
Absolutely. I love that. Yep.
So there are plenty of different options to get access to these Roth retirement plan accounts. The smartest thing to do, in our opinion, would be obviously to create a financial plan, stick to the plan, hire a financial advisor. I know we're biased saying that, but it really does help kind of clarify if it makes sense to even contribute to a Roth 401k or Roth IRA. But those are the main differences that we see between those two different types of accounts. If you have any questions, leave them in the comments below. We'll answer as many as we see. If you like seeing videos like this, leave a like and subscribe to the channel for more videos, and we'll see you in the next one.